We've got Sudipta Roy, CEO at L&T Finance, waiting by. Sudipta, great to have you in ET now. You've guided to grow at a 20% CAGR through FY 2031. You're currently growing at 27%. Should investors now upgrade their FY 27 book growth estimates toward 25% plus, or should we expect to grow at a more moderate materially over the next 3 quarters?
I think it's a very pertinent question on growth. Over the Lakshya 2031 period, we have guided for a 20% CAGR growth across 5 years. It is right that we have grown at almost 27% this quarter. And one of the things we would like to make very clear is that if there is risk-calibrated growth available in the market, then we are not bound by that 20% number. However, over a period of 5 years, we are committed to that 20% growth number, because the fact is business does not move in straight lines. There are ups and downs in businesses. There are certain times risk-calibrated growth available in certain business lines. There are times, you have to tighten because the risk environment is not proper, right? So what we want to make it very clear is that there is risk. If there is risk-calibrated growth opportunity available in the market, we will not shy away from taking it. However, overall, our guidance for the Lakshya sort of 2031 period across 5 years is 20% CAGR, and we remain committed to that. If the market conditions remain benign over a larger part of this 5 years, then yes, we might see a growth rate which is higher than 20%. But because 5 years is a long term to sort of time to predict, with certainty sitting at this particular point in time, our guidance is on 20% CAGR. However, if conditions exist which are favorable, we will grow at 20% plus.
And your overall disbursements were down, 1% sequential, Mr. Roy. Rural business finance disbursements declined 3%. Gold finance was down as well. Both rural and gold were identified by you in April as important from an FY 27 growth engine perspective. Is this simply seasonality? What's playing out? Could you give us a sense?
I think Q4 is typically the high quarter of BFSI, wherein all the engines start fire, and you typically have a very good outcome in terms of disbursements. Q1 traditionally is a weaker quarter for BFSI. However, as you can see, many of our business lines have grown well. The rural business finance vertical obviously saw a little bit of sluggishness in the month of June, primarily because of the delay in monsoons, because typically June and July for microfinance business are large months. And because the monsoon was a little bit delayed, about 3 weeks delayed, some of the offtake was a little bit moderated in the month of June. The gold loans business actually went through a little bit of adjustment phase post the implementation of the RBI guidelines, the new RBI guidelines from 1st of April. And obviously that saw a little bit of slowdown in disbursements, because we wanted to be very, very careful and make sure that everything that we do right in our gold loan branches are exactly according to the RBI guidelines. That led to a little bit of tempering of growth in the month of April, but it has picked up in the month of May and June. And we believe that Q2 of FY 27 will be business as usual for gold loans. We continue to deploy our gold loan branches at a good pace. And we are committed to deploying about 500 new gold loan branches this year. However, just also because of the West Asia war, we have pruned just out of more prudent cautiousness. We have pruned a little bit of our disbursements on the margin, especially on the riskier margin on our personal loans business, our loan against property disbursement, as well as our SME disbursements. Actually, we could have grown faster during this period, but we consciously chose to shave off about 1,000 to 1,200 crores of our disbursement in the businesses that I mentioned before, just to make sure that our risk metrics remain stable. And as we have already and always articulated that we are a risk first and a tech first retail financier of choice, so we will never trade growth for risk. So obviously, our overall Q1 calibration of disbursement has been risk calibrated, and we have taken opportunities where growth was available, and we have been sort of cautious where we felt that there might be downward risks later on.
Right. And since you did mention about rainfall deficit, given your 50% exposure to the rural portfolios, are you seeing early warning sign systems showing any deterioration in collections, bounce rates, or stage 2 formation?
No, as of now, we do not see any significant sort of accumulation or risk in any of our lines of business on account of El Nino. Let me say that, though monsoon has had a delayed start, we have had decent amount of rains in the first few weeks of July. And right now, the sort of the deficit as of 10th July was about 14%. We believe, the long period average as predicted by IMD at 90% will be sufficient to sort of for agricultural needs this year, primarily because reservoir levels, because of two very good monsoons in the prior 2 years, are at a decent level in most of parts of India, and they're sufficient enough to sort of suffice the agricultural needs. Now, in terms of our assessment of the market condition, we have made extensive field visits over the last 2 months, primarily to assess the sort of impact of the West Asia crisis, the increasing fuel energy prices, as well as delayed monsoon. And we haven't found that sort of any indications of any sort of rural stress or pockets of rural stress building. We do believe that this will be quite a normal year in spite of the delayed monsoons or a little subpar monsoon, because of the fact that the reservoir levels are good and because of the fact that we have just come out of a microfinance crisis. Typically, the 18 months window post any sort of asset cycle is typically a Goldilocks window where you have, very good quality credit available. So we do not expect sort of any sort of adverse outcomes with respect to risk in any of our portfolios this year. However, saying that, we will remain cautious, and we have built tools like Nostradamus, which is our automated portfolio management engine that actually shows up risk much before it becomes apparent in real terms. So we continue to monitor that, and we are very, very certain that given our capabilities and given the sort of understanding of the sort of economic marketplace, economic scenario that we have, this year will be a pretty normal year.
And NIM compressed about 25 odd bips, but fee income conveniently offset that entirely. NIM plus fee generally is how you look at your numbers. What happens to NIM plus fee? Talk to us about how it shapes up going forward. Any revision in guidance here, since you've already achieved the top end of your guided corridor and sustainability?
If you see our yields have relatively remained, flat. It has actually gone up by 1 basis point compared to last quarter. However, because of leverage and because of the, weighted average cost of borrowing has gone up by about 3 basis points on a QoQ basis, our overall cost of funding went up, had a 25 basis points impact on our overall NIMs. However, that has been compensated. We kept a large amount of liquidity because, because of the West Asia crisis, we wanted to hold a little bit of liquidity on our balance sheet. So, some of our fees have been inflated by some part of the liquidity income. We have had good recoveries, especially on other charges in collections in our personal loans business, as well as in our SME business, as well as have a little amount of higher realizations in higher penetration of insurance as well. So overall, the fees have grown northwards, and there has been a slight compression in NIMs on a QoQ basis, primarily because of weighted average cost of borrowing going up slightly and because of increased leverage. However, on an overall basis, on a quarter-on-quarter, our NIMs and fees have relatively remained stable. We as an organization have guided that we will try to maintain our NIMs and fees in the corridor of 10 to 10.5%, and we remain committed to that.
Right. But Sudipta, in April, credit cost was around 2.64% for you, and you guided to about 2 to 2.25% by Q4. After 1 quarter, you're currently at 2.54. Is the pace of improvement exactly where you expected it to be? And can you rank the top 3 contributors, to the expected 34, 54 basis points of credit cost reduction from here?
See, the first thing is that we remain committed to the sort of achieving the 2 to 2.2% credit cost corridor by Q4 FY27. Currently, we are at 2.54% at the end of this quarter. I think from here, we will continue about 10 to 15 basis points. There will be a journey every quarter downwards. And the primary sort of contributor to this downwards journey is the cautious, calibrated disbursements that we have done over the last couple of years. The first contributor is the efficacy of Cyclops. As you know, Cyclops is our AI-based credit engine, which we implemented in the two-wheeler business in June 2024. It's been exactly 24 months, and the headline results are very, very good. In fact, all the details about the efficacy of Cyclops is given in slide 14 of our investor presentation. Plus, also we have implemented Cyclops in our SME business, in our tractor business, as well as in our personal loan business. And we are seeing good headline improvement in our credit costs from there. Because we have been very, very prudent over the last 2 years, the fact is that the overall the downward trajectory in moderation of credit cost is continuing. We have improved our collections mechanisms as well. A lot of our collections is now sort of driven by AI bots, so which has actually led to an efficacy in terms of our self-cures. Previously, when our self-cures used to be about 10 to 11%, our self-cures are now about 40 to 42%, leaving our field teams a lot of bandwidth and energy to focus on the hard cases, which has led to over-realization and faster resolution of our hard buckets as well. So overall, the improvement of the ingress of the book that has been happening over the last 2 years, as well as improved collection efficiency, as well as improved collections metrics, will show up in lower credit cost. We remain committed to that guided corridor of 2 to 2.2%. And as you have seen, our Lakshya 2031 goals, we have guided that our credit costs should go below 2%. That is sort of the goals that we are holding ours to. So the achievement of 2 to 2.2% corridor in Q4 FY27 does not mean that we stop. We continue pushing the needle so that we end up with that within the trajectory of less than 2% credit cost as part of our.
And Mr. Roy, with regard to stage 1 and stage 2 coverage, may still need to increase further. Rapidly growing unsecured portfolio starts to season, will likely need that. Does your 2 to 2.2% guidance already incorporate any additional PCR strengthening?
See, currently our overall PCR, we are about 69% levels. And the fact is that if you see, the PCR actually has improved from last quarter. So we remain committed. We do believe that the 69 to 70% PCR that we have been operating in is one of the highest in the industry. And we remain committed to sort of strengthening this at this particular level, at this level. I think 70% is good enough for a business of our trajectory, especially if we drive down credit costs below 2 to 2.2%, it gives sufficient cushion. But as and when opportunities arise, we have said that any over realizations from our wholesale portfolio will go into strengthen our sort of our macroprudential provisions as well as our provision coverage ratios. We will not shy away from doing that. And as and when those opportunities arise, we'll keep sort of improving our PCR. But however, in conclusion, I would say the PCR at this particular levels within the 69 to 70% range, we do believe is sufficient.
Right. Sudipta, great having you today on the show. Thank you so much for your time.